We're getting a little skittish. We're late in the cycle. It's been 10 plus years of a bull market. The estimators are 29-0, 29 straight quarters. They predicted a certain number on earnings. 29 quarters in a row, they underestimated the earnings. I think what we're seeing now with about 20% of the companies reporting is that we're coming in above the consensus. There is some slowing, and everybody, I think, expects 2020 to be much better. So I think until we get some of these broader issues done, the trade thing still hanging out there, the longer it hangs out there, the more pressure it potentially puts on earnings because we're starting to see some slowdown as a result of that. So that's the big thing to be looking at is we can ultimately get a trade deal. Then I think you'd see some revisions up in earnings. But even if we don't get there, it looks okay so far for the remainder of this year, and 2020 looks better for earnings.
Joe, you're recommending clients underweight equities and risk. What's the primary driver of that?
Well, when you see just how markets have behaved so far year to date, you've had this spectacular rally. And all of this is happening, of course, at a time in which global economic growth is decelerating. And the earnings picture has really just been uninspiring, if anything. We're looking at modestly flat to slightly positive earnings growth this year. And I think when we take a look at 2020, those numbers, while they are going to accelerate from the levels we've seen so far this year, I think they're probably going to come down a little bit, which means everything that we're seeing in the markets right now is driven by multiple expansion. And you have to ask yourself, can this multiple expansion continue indefinitely purely on the back of the Fed cutting interest rates? I think you have to sell into this market strength and just proceed with a little bit of caution.
So if you are underweight equities, where's that allocation going?
Well, if you're underweight equities, naturally, you end up going into more defensive assets, such as either cash or into bonds. And despite the fact that interest rates have come down considerably, I think this is part of just being a little bit more defensive in your portfolio. You have to ask yourself, with the rally we've seen so far this year, are risks potentially skewed to the downside? We're not calling for a recession, but we do think you should sell into this market strength and just lock in some of those gains, if you will.
Are risks skewed to the downside, Sean?
Excuse me?
Are risks skewed to the downside?
I think there's more potential downside risk with some of these events. You know, we have strategies that use trend following mechanism, the 200-day average primarily, we call it trend pilot. All of those indexes are currently above. I think investors need to start positioning their portfolios for what happens. We had a nice fire drill in the fourth quarter of last year that should have given people an opportunity to prepare for the inevitable bear market which will come. It's just nobody knows when it's coming.